sessions, and it's a wonderful place. I feel like I'm kind of in enemy territory here. I went to Biola. I don't think that was mentioned. And I've heard that APU is right down the street. But I'll tell you this. One of my good friends who I actually went to school at Biola with, and he lives across the street from me now, just got named president. So Adam Morris, you guys have probably all heard that. I think a couple of weeks ago he got named. He's a really good guy. So we're making inroads up here. So watch out, right? We're coming for you. So I was trying to figure out what to talk about here today, what would be most important for you all to hear. Didn't know what the attendance was going to be. And I've got some things that I think are applicable to people in all stages of their journey through life. And we heard a little bit before about mentorship, and so, maybe your finances are all set and you're good there, but maybe you're talking to somebody who's younger, kind of starting on their journey, and maybe some of this will help them. So I'm hoping that you'll be able to pick things out that can help you or help people that you may be talking to. And again, whether you're just beginning or whether you're nearing the end, maybe starting to think about retirement. And I hope also it's applicable to people who maybe don't have very much money and some people who may have a ton of money, right? We work with a lot of different people. We actually like to work with everybody. I like to think I get as much joy out of helping like a 25-year-old start on their way and give them tips as I get joy from helping someone who's about to retire and has got $5 million. Actually, sometimes it makes me feel smarter to be able to help a 25-year-old because I can tell them things they don't know, and it's a lot of fun. It's a lot of fun for me. So I'm hoping you can take something from this. We heard earlier about one of the commandments being to master your money. One of the taglines that we considered using for our firm was professional wealth stewardship. It's something I really liked. We ended up not choosing it when we were looking at doing marketing, but I like to think that we try to teach people a lot about stewardship. It's taking care of something that's not yours, right? It's everything is God's. We're here to take care of it while we're on the earth, and He's entrusted us with stuff for ourselves, but it's really His. So being a good steward, I think, is a good place to start. So with that, I'll kick off the presentation here. I'm going to cover a lot of the foundational stuff that we talk with people about, and then we'll talk about some investing things, and if we have time toward the end, I'll talk about how to choose a financial advisor, what to look for in an advisor. We may not have time to get into that, which is fine. I'm actually way more comfortable taking questions. I don't think we're going to do that, but if we have time at the end and there's a way to do it, I'd be happy to do it, as opposed to just hearing myself ramble. So, let me get started. One of the first things we'll talk to people about when they come to see us, especially if they're having issues financially, is to set up a budget. And living within your means is where to start. If you can't do that, you're going to kind of be behind the 8 ball maybe your whole life. I say on here that budget is a 4-letter word. Nobody wants to do a budget. Everybody hates budgeting. But if you've got debts piling up, if you just can't make it month to month, it's probably the best place you can start to get on the right track. The way to do it, and the way we'll tell people to do it if they're having issues, is to track all of their spending. And there are real easy ways to do that now. I'll tell people that there are things like Quicken and Mint, where you basically hook up your credit cards or your bank account to Mint, let's say, and then every transaction that happens gets uploaded into their program and categorized, so you can look at it at the end of the month, sit down with your wife or whoever you're working with, go over what you've spent during the month, and then set goals, right? If you, you feel like you're spending too much money on a Starbucks, whatever, and you look at the end of the month and it's, $300, and you're like, that's a little bit too much. Let's see if we can cut that to, $250 next month. It's a real easy way to try to get on track by using a program like this, so you don't have to keep it manually. When I started, I'm actually in my 30th year in the business, which is crazy. I've got a lot of stories in here from clients too that we'll talk about. I used to tell people to keep like a pad of paper on their dresser, and when they came home at night, just write down everything they spent during the day. If that works for you, that's fine. We've got better tools now that can be used. And so whatever works for you, somehow keep track of your spending, set goals on what you want it to be, and then work toward getting to those goals as time goes by. And ultimately, the idea would be that you control your spending enough to allow yourself to have some left over at the end of the month, and then you can start saving and working toward the future. So live within your means. It's the first thing we'll tell people if they're having trouble. Another foundational thing is being careful with debt. There's a lot of ways to get in trouble. You guys know that, like credit card companies, it's in their best interest to get you to borrow as much as you can from them. and they'll always give you more than you really should have in terms of credit. So you got to be careful, right? Just because someone tells you that you can take out a massive credit card or take out a huge home equity loan doesn't mean that you should. We saw an awful lot of people get into trouble back in '08 before the financial crisis happened with home loans, right? Adjustable home loans. They got sold a payment on a loan, and a loan that they didn't necessarily understand. And when the rate on the loan started going up and their payments started doubling or tripling and they couldn't handle it, they were told they could just refinance the loan or sell the house and it'd be fine. But what they didn't get told is that maybe rates were higher, or you couldn't qualify for a loan, or house prices would be down. And so we got into the issue with a ton of foreclosures back then, people with their credit ruined. So again, just because somebody is willing to loan you money doesn't mean you should do it. You got to take responsibility and see if you really can borrow the money, can afford to pay it back, and make sure you understand all the terms that might be in there. Credit cards, you probably know this too, but if you look at a credit card statement, I think they have to tell you now, like if you make the minimum payment every month, how long it's going to take to get the credit card paid off, right? I think that was a legal disclosure. And if you look at it, I want to say it's usually like 15 or 20 years. So they're happy, right, to charge you 12, 13, 15% interest every month and let you keep paying on the loan for 15 years, and that's in their best interest, but not yours. So be careful with credit cards. Be careful borrowing money. We've had issues. I'll never forget the time I sat down with a husband and wife. Didn't know exactly what they were coming in to see me about, and she laid down a piece of paper on the table with about $40,000 of credit card debt on it, and I'm like, all right, I think I need to help them figure this out. But the problem was her husband didn't know about it, right? So there's all this debt. He didn't know about it. We had to figure out a plan for them to get through it, which we did, and they're actually in better shape now, so we're proud of ourselves for doing that. But it's a real slippery slope to get on. Again, they'll loan you more money than you should borrow. So be careful with that. More foundational stuff. Life insurance. Just a little bit of commenting here. There are different kinds of life insurance out there. There's term and there's whole life. In our opinion, when we look at life insurance for somebody, we think it's best to take out the coverage in the most inexpensive way possible, and that's typically term insurance. So term insurance is maybe called pay-as-you-go insurance, so as long as you pay the premiums on this thing, you've got this policy in effect. If you stop paying the premiums, the policy goes away. Whole life is somewhat similar, except that it's got what I'll call a savings account attached to it, and so you pay more. Some goes to the insurance cost, some goes into the savings account, and it builds up. So that if you stop paying the premiums, that savings account will pay the premiums for a little while. The problem is that whole life, as I'm saying here, it's about 3 times the cost on a monthly basis or an annual basis if you look at it. And so it's pretty expensive. Sometimes the expenses associated with it are high also. So our preference is term insurance. There are reasons that whole life can make sense. I'll mention one in a minute here. But we usually like to keep the insurance as inexpensive as we can, as long as you get the coverage that you need. I gave you a rate here. $1 million term policy on a healthy 40-year-old should be somewhere around $50 a month. That's probably for a 5 or a 10-year policy. So you can get term insurance pretty cheaply as long as you're in good health. If you're not in good health, the cost is going to go up. And it will cover your family, basically, right? You're not around to collect on it because the only way you collect is if you die. But if, right, that's, a little gallows humor. But what we tell people when you need insurance, if you've got a family that would be financially devastated, if something were to happen to you, if you've got kids that need college funding, if you've got a wife that needs a mortgage paid off, if you've got a wife that would be so sad she couldn't work for a long time, and I hope that's the case for everybody, right? So you're going to want to leave her 5 years worth of money that she can sit on and spend before she has to go back to work. Those are the things that we think people need life insurance to cover, and so we'll recommend that if they don't have it in place. I'll tell you, we've recommended whole life in a couple examples. One's just real recently. If you have a really, really large estate, there can be good reasons for life insurance. We've got a client he's in good shape, so he's worth maybe $50 million. And so if he were to pass away, his family's going to have an estate tax problem, right? Because the government's going to tax anything over, $12 million, I think. Life insurance is one of the few things that you can own outside of your estate. which in his case can make some sense because you get money out of the estate, goes to the kids tax-free, and it's not subject to like a 50% estate tax. So that's one of the rare cases where I think whole life insurance can make sense, but unfortunately that's a pretty isolated example. He's about our only client who's in that situation. One other story, actually it was my friend. I went to Biola with him. We played baseball together there. He passed away when he was 30. He wasn't a client. His wife and he, actually before he passed away, thought they had plenty of life insurance. It turned out it was accidental death and dismemberment insurance, so it was an insurance policy, and if he would have died as a result of an accident, it would have paid off. In his case, he was sick, he had cancer, and so it didn't pay off, right? So they thought they had life insurance, they thought they were going to be covered if something were to happen to him. Something did happen to him, and they weren't covered. So make sure that you know what you have. Make sure you know what you're buying. That's going to be a theme that runs through here. Saving for retirement. Start to move on in life, right? You got to save for retirement. I think Einstein got quoted a little bit earlier here. He's said to have said a lot of things, right? But one of the things he's said to have said is that compound interest is the eighth wonder of the world. So I've got a little example here, and the example is this. If you start, let's say when you're 30 years old, and you save $200 a month for 10 years, so that's a total of $24,000, and you earn 9% a year, which is somewhere around what the stock market tends to earn. And then you stop, right? You let it sit and grow for 25 years until you're 65. When you're 65, you'd have $314,000 or so, call it in the bank or in an investment account. If you contrast that with a guy who saves $200 a month also, but he doesn't start until he's 40 years old, so he puts a total of $60,000 away, right? And he earns the same investment return, the 9% rate. But at 65, when he's ready to retire, that's when he stops saving. That nest egg that he's put away is only about $200,000. So the math is always interesting to me. And the reason for it, obviously, is that the earlier you start, the earlier you give your money a chance to start earning that 9% rate, and the more it can grow over time. So if you're starting out, start early, put money away where you can. If you're talking to someone who's doing that, your kids, grandkids, whoever it is, get them to start early. It's a really good thing, and the money can add up tremendously over the years. We'll talk about different ways to do that in a minute here. Figuring out where to invest for retirement or for anything else, really. Retirement especially, I'll focus on here. This is kind of the checklist that we'll go down as we talk with people about how to save for retirement. The first question I'll ask people is, do you have a 401k available at your job? And what are the terms of that? So is there matching, right? Is the company offering to give you money if you put money in? And most 401ks do. The ones we see these days, typically, they'll put in, they'll match up to the first 3% that you put in out of your paycheck. And so I'll tell people all the time, if you're not at least taking advantage of that 3% match, you're leaving free money on the table, right? Who doesn't want free money? You don't want to walk away from that. So you want to do whatever you can do to take full advantage of the match. If people here are working at APU, I know Biola had a real generous plan. We work with people. I think they put in like 8% if you put in 5%. APU might have something similar. I don't know if there's anyone here. You want to find out what the terms are to make sure that you're not leaving money on the table. It's because you just don't want to do it. That's anathema to a financial planner. 401ks, you probably know the mechanics of them. Basically, you sign up, money gets deducted from your paycheck and sent off. That's another, call it a secret to retirement success, is automating as much as you can. We'll always want to tell people to push it a little bit to save a little more than they think they can when they're starting out. Because what we've seen is that if you start saving and it comes right out of your paycheck and you never see it, pretty soon you just forget about it, right? It's gone. It's not a part of your income. It goes off and it grows for you so that your retirement starts to get taken care of. And the other advantage with the 401k generally, there's some nuances here. It's a pre-tax savings, right? So if you make, $5,000 a month, normally you pay tax on that $5,000 a month. If you defer $1,000 a month into the 401k, you're only going to pay tax on the $4,000 that you keep. So it helps by automating things, it helps by reducing your taxes, and it helps by making sure that money's put away from you without even having to think about it. 403bs are similar things. They're almost identical to 401ks. They're offered by nonprofits and educational systems. Public schools, if anybody's a teacher here, they probably have 403bs available to them through their district. It's surprising to me. Teachers don't always activate those, right? They know their participants in STRS or PERS, whatever the state retirement system is, which is good. 403Bs, you've got to kind of take responsibility yourself, get into it, and then start having the money sent out of your paycheck. Roth IRAs are another good way to save for retirement, really good way, especially for people who are just starting out. You guys probably know the difference between a Roth IRA and a traditional IRA. With a traditional IRA, it's like a 401k. You get a tax deduction when you put money in, which is nice. The downside of that is that when you start to pull money out, when you're retired, you have to pay tax on all the money that comes out of your IRA, kind of like a normal 401k. With a Roth IRA, you don't get a tax deduction as you start to put money in, but the advantage is that over time it grows. You don't pay tax on it as it grows. And then when you get to be, let's say, 60 or 65, and you're ready to pull the money out, you can do that, and you don't have to pay any tax at all. Probably the best story I've heard in the last 6 months, it was Peter Thiel, who was one of the founders of Facebook, maybe PayPal. Roth IRAs came out in 1998. He ended up putting, I think it was like $1,990 into his Roth, because the maximum was $2,000. And he ended up putting like founder stock for PayPal, I think, at that point, into his Roth. So he put $2,000 in, 24 years ago? Any guesses on what that's worth now? Anybody know? It's $5.2 billion is what he turned that money into. So that caught my attention when I saw it. So the cool thing is he put the money in early. It was $2,000. It's $5 billion. The other cool thing is that it's a Roth IRA, right? The investment return on its own is pretty good. The fact that it's in a Roth IRA means that he doesn't have to pay tax on that ever. So the government didn't necessarily like it. And then the last proposal, it was some legislation, I think it was the Build Back Better legislation. They actually proposed mandatory distributions from Roth IRAs if you have that much. I think if you have over like 20 million in there. But no taxation still. So he's in good shape on that. I wish we could promise investment returns that good. We're not going to do it. You're probably not going to do it. But if you can start to fund Roth IRAs early, it's a good thing. And when your tax bracket is low, so this is for people just starting out in their jobs, the tax deduction is not as valuable for them because they're in the lower bracket. And so they don't need it. They can put it in there and let it grow tax-free, and then when they're ready to take it out, they don't have to pay any more tax. So really, really good way to save for retirement, even if you're not Peter Thiel with access to founder stock. Deductible IRA, similar thing. Roth IRAs come with limitations. If you make too much money, you can't fund a Roth IRA. The same goes for a deductible IRA. The point is that putting money away in retirement accounts is good. If you're self-employed, there are plenty of ways to set up retirement plans. The tax code gives us options on that so that you can set up retirement plans for yourself, just like big companies set up retirement plans for their employees. We set up a lot of one-person 401ks. They're really flexible. They let people put in a bunch of money if they want to. They're inexpensive to maintain, and you can vary contributions. So there's a lot of flexibility there. So don't think that just because you may be working for yourself that you don't have a retirement plan available. There's almost always some way you can start saving for retirement. More on the lines of retirement here. Figuring out when you can retire. We actually spend probably more time on this with our clients than any other subject. That's typically what they come to us for. They're thinking about retiring, and the question is, can I? What do I need to do to get there if I can? So the questions that we'll walk through with people and that you can walk through on your own, how much do you need to live on, right? This goes back to the budgeting situation where you need to keep track of what you spend so that you know what you need to live on during retirement. What we see with people who are moving into retirement is that typically they'll spend about the same in early retirement as they were spending during the last few years that they're working. There's no massive drop in spending usually. Sometimes there's an increase, right? Because you've got, 9 or 10 hours a day that you're not making money and instead you're spending it. So sometimes spending actually goes up. And if you know how much you need for retirement based on the budget that you're keeping, you can do a much better job planning. We had a client, he's an ENT, a real successful doctor. I think he was actually up in this area. He was making good money, so he's making $400,000 a year or something. We ran retirement projections for him, and I think initially we said he could only spend like $250,000 a year in retirement, and so we were concerned. I'm like, that's pretty good, and yet it's a big drop from what you're making right now. And I told him, I said, go home, you keep a budget. He never had to keep a budget, right? He was making enough money not to worry about it really. And he did that for 2 years, and he came back and he laid it down in front of me, and he said, look, I think we can do this on like $220,000 a year. I said, all right, well, I think you can retire then. So it was a really good exercise to go through, and it reinforced the value of budgeting and keeping track of what you spend, right? Not just when you're starting out, but also when you're preparing for retirement. So it's how much do you need to live on in retirement? The other thing to keep in mind on that note is that you've got to factor inflation in, right? So if you're still 15 years away from retirement, inflation is probably going to be an issue between now and then. So $100,000 today is not going to buy you as much as $100,000 does 15 years from now, especially if inflation keeps going the way it is right now, right? We may need like $100,000 a year to buy gasoline. So it's how much you need to live on. The other way to approach it, once you figure that, is how much you need to save, right? So if somebody's got a bunch of time to go before they retire, we work with them on figuring out how much they need to save in order to get to retirement. Where are your assets? What's the total? Right? Basically the question here is what kind of assets are available for retirement. So make sure you know, like investment accounts, pensions they can get lost. Actually, we see people lose visibility on those if they've had jobs years ago that they've left. They may be entitled to a pension there. So you want to make sure you gather everything, figure out where it's coming from, and then figure out how to take it. Pensions have a lot of options. We work through options with people. So where this applies most often these days is people who work in government jobs, so school teachers or government employees. Traditional pensions are becoming a thing of the past. But for those people, you always hear about like firemen or teachers being able to retire at, say, 55 on 80% of their income. The headline is usually true on that, but when you get into the details on that, you got to figure out how much you can actually take, because if you take that amount maybe and you pass away like 2 years in retirement, maybe your survivor, your spouse, gets nothing. So you've got to figure out how to take pensions and what you want to leave to your surviving spouse if something were to happen, and sometimes that's less than what you think based on the headline as far as what you're looking at in your pension. Other things to think about when you look at retirement, besides sources of income, any inheritance. We typically don't like to count chickens before they hatch, so we don't count inheritances, but you've got parents who are extremely wealthy and you know that there's probably going to be something. We'll factor that in at times. Major changes that affect finances. The one that comes up most often is like a downsize in a residency in your house. You're going to sell your house and live in a cheaper house. So we'll factor that in if it becomes pretty clear that that's going to happen. It seems like everybody these days is looking at leaving California, so they want to sell for $1 million here and buy in Texas for $400,000. Can we factor that into the retirement planning? And a lot of times we can. A note on that from what we've seen, that we can do spreadsheets all day long. The numbers are easy. We've seen clients do this. They move to, let's say, Texas for whatever reason, cheaper housing a lot of the time. No state taxes is the other thing. We've seen clients do that and become unhappy because they focus on this cool house they can buy in Texas, and they forget that like all their friends are here and they've had friends here for 35 years, right? And they leave their friends and you sit in this really nice house in Texas and look at each other. It gets like, how long can that? If your relationship with your wives are awesome, that's great, but it only goes so far, right? And then we've actually run numbers for people who have moved out of California in order to save income taxes because they're going to live in Texas with no state tax. And they end up paying more in taxes because property taxes they're double actually in Texas as far as the rate goes versus California. And this person in particular, their income was relatively low, so they didn't save a lot in income taxes, but they ended up paying a bunch more in property taxes. So look at all the factors when you look at that kind of a thing. There's a kind of a rule of thumb called a 4% rule, which you might have heard, and that rule says that when you retire at about age 65, if you start by taking about 4% withdrawals from your investment accounts, your money should last for, let's say, 30 years. That's about what it would say. And you should be safe by taking that amount every year. And that amount should be able to increase every year by the rate of inflation. So that's a real general rule of thumb. It's not far off. We actually run more specific numbers. But a lot of times we come back to a number that's not too different than that. It assumes that you invest the money in certain ways and take advantage of growth in the stock market. But if your situation is completely generic, that's not a bad rule of thumb to go off of for retirement, right? You can start by taking 4% withdrawals from whatever investments you have, and the money should last through retirement. One of my friends actually, who's another advisor, started this thing back like 25 years ago, back tested it through all kinds of stock markets, and it tends to work like 95% of the time. So that's where that comes from. If you want a quick and dirty way to calculate whether you can afford to retire, that's not a bad place to start. One other quick thing on retirement withdrawals, the way we run it is to show steady withdrawals throughout retirement, aside from an inflation adjustment. We like to stay conservative, so we do it that way. What we've seen is that when people get into let's say their mid-80s, their spending actually starts to decline. We like to run assets all the way to 95, that's around life expectancy, but we've seen expenses tend to decline when people hit their late 80s or mid-80s. It depends on how healthy they are and how much they're doing, but expenses typically slow down. The wild card always is medical expenses. You never know. The last, say, 6 months of somebody's life tends to be really expensive in some cases, right? If they have to go into some kind of facility or get medical care. So you want to factor that in. But generally, costs go down the farther you get into retirement just because activity slows down a little bit. That's all I'm going to say there. I've got some slides in here about how to invest the money. There's different ways to invest. I'm going to skip over this, but in general here, we'll tell people to match the risk. That third point down, match the risk to when they'll need the money. If it's retirement, you can think long term. That implies to me that you can afford to be more aggressive with your money, which means in our case, what we believe is that you should favor the stock market. But if you're putting money away for, let's say, a house that you're going to need to come up with a down payment for in 8 months, to me, the stock market's not a good place for that. Because who knows what the stock market's going to do on Monday, let alone 8 months from now? We don't know. And so if it's a short-term time horizon, you want to be more conservative with the money. That's a generality, but we try to match risk with duration on when the money's going to be needed. One more thing on this too. I'm going to have to wrap this up. Don't take risks you don't understand, and don't invest in things you don't understand. We've seen a rash, for whatever reason lately, of people coming to us who have been, we don't favor annuities. This gets into personal preference. People get sold annuities or insurance policies that are really expensive. We met with a lady just a couple of weeks ago, and she had an annuity, and it was earning like 0.5% a year, and there was, I think, $450,000 in it. But the advisor that she had put it into an index annuity, and to get out of it, even though she's had it for like 9 years, she was going to have to pay a 17% surrender charge. We've seen a lot of that lately, and the cynical side of me says that the reason that happens is because the annuity salesman gets paid a good commission. They do. They get paid really, really good commissions on these. So I'll say, and again, this is personal preference. We happen to be on the other side of it. If you're going to put money into a life insurance policy or an annuity, ask the question, like, what if I need the money out a couple of years from now? What kind of costs would I have to pay to do that? What are the terms? The surrender charges on these annuities that she had ran for 20 years. So, unless she waited 20 years, she wasn't going to be able to get the money out without paying a penalty on it. A couple of things on investing. I've mentioned a couple of times that we favor the stock market. The stock market is volatile. No one, I don't think, has missed that if you've been paying attention to what's going on this year. Many different things could affect the stock market. The two primary things in my mind that are affecting it right now are the war in Europe and inflation, right? They kind of go hand in hand. What we're trying to tell our clients is that, typically you don't want to overreact to that kind of a thing. You want to put together a long-term strategy, generally stick with it, because trying to time the market is not an easy thing to do. The market's going to go down. This chart we like to show, it's hard to, I think it's really hard to read for you guys, but basically the solid bars are the return of the market on a year-by-year basis since 1980. The red circles on the bottom would be the maximum loss that you'd go through over the course of a calendar year. So if we look at 2020, which would be the third from the right, you can see the market returned around 15-16% for the year, but during that year, there was a 34% decline, right? That was COVID, right? That was February, March of 2020. So even though we saw that 34% decline over the course of a month, and I'll tell you, I didn't sleep at all that month. It was an awful, awful month. because nobody knew it was going to happen, right? No one knew if it was going to infect the world and kill everybody. It didn't, fortunately. So we saw the decline, but by the end of the year, the market was up by 16%. So you forget this, but investing involves risk, and in our opinion, investing involves riding through that risk, and if you can do that, you'll get the returns of the market, even though you have to put up with the negative times during the year. So as far as the situation right now, I think the market's at the end of February, it might have been down 10 or 12%, not even a huge decline by these standards, but it felt awful, right? Everybody wants to sell when it goes down. My opinion, hang on, don't make decisions based on your emotions, which are almost always going to tell you to do the wrong thing at the wrong time. So I am going to end with that. That's my big conclusion. I didn't get through everything, which I think is okay. I'll call it quits. Again, I'd love to take questions. I don't know if we have any time, but if you can do it.
Yes, let's do questions.
Okay, perfect. That's perfect.
I have 8 questions for you.
8 questions? Okay. Start with you. You have anything on charity? I didn't get to that part of it.
Yes, I will. Actually, I do.
Do that. That's great.
Thank you. This was so good. It's so clear, so wonderful. Thank you so much for doing this. And so I'll just rapid fire a few questions at you. Just
sure.
A couple things I was thinking. I had a professor in school who said, never read a good book if you can read a better book. Okay. And so just in terms of, with everything you're saying, do you have a top recommendation, kind of 2 levels, kind of entry level, like, you know, Dave Ramsey's Total Money Makeover? What's an entry level book that you would recommend to us, and then people who are a little more advanced? Or a podcast?
So Dave Ramsey has excellent ideas, I think, on personal finance in general. Some of his investing ideas I may disagree slightly with, so whatever he writes is going to be good. Jack Bogle, who is the founder of Vanguard, wrote some really good, more like high-level books, like How Much Is Enough, things like that. He's a great guy. So this is a cool story. That he was worth like maybe $80 million. I heard him speaking in a hotel in downtown LA. This is years ago. And he wanted a drink, right? And so he was at the buffet table. He had this little bottle of Pepsi. He's like, I'm going to take one of these, even though Vanguard's paying for it, and it costs us $2, and it kills me. So he's a really, really frugal guy. He did really well. But that's the kind of guy you want to look to invest with. So he wrote good books. Vanguard's a great company. I'll leave it at that.
That's good. Why don't you go ahead and talk about charity? I was going to ask you, just specifically in a Christian biblical setting, you know, we talk about tithing and giving and that kind of stuff, but just generosity in general. So you can merge your biblical world or your professional world, but just talk about that.
Charity's a really cool thing. I've got almost any of these slides I could probably spend a half hour on, which is a problem with this. There's one: be charitable, give generously, start early. Good story. Our longest. She was our first client, actually. She joined us in like 1985. Her name was Lucy Swindoll. She just passed away. You guys might know the Swindoll name. She didn't worry about us telling stories. She actually wrote them up in her book, what we told her to do. She was not giving, and she like all of a sudden became convicted, and we told her you should start giving 20%. She goes, no, that's not good. I'm going to start giving 30%. So from the time we talked to her until the time she passed away, she gave like 30% of her income away every year. And she would always say, you can't outgive God. You want to give generously, start as early as you can, but like by her own admission, it's never too late to start. Couple of really quick ways. We like to have our clients give donations out of their IRAs when they're taking mandatory distributions. When you turn 72, you have to start doing that. That's probably the best way we've seen to give. That's the one mechanical thing I'll talk about here.
Do you have any insight as to why it works? Generosity.
Why generosity?
I mean, from a Bible perspective,
because the Bible says it does. I mean,
I think that counts. That counts. But
you want me to keep going, though? You know, it works. I think. Well, because literally, right? God's commanded us to do it. There's going to be blessings that come along with it. So that's part of it. I also believe that it's a change in your mindset. If you really believe that everything in the earth belongs to God, right? There's a verse, I think it's in Chronicles, that talks about that. The cattle on 1,000 hills, they're all His. And so if you can shift your mindset to that and recognize that you're just a steward taking care of it, it makes it much easier to give things away. And I also believe it makes a shift in your thinking so that you can live within your means and do everything else right, too. So a lot of dividends there, literally, actually.
So good. Well, some of my questions are kind of just random. So if you were my advisor, how much should I trust you? And how much should do I need to know
you
on
can
my
trust
own?
me implicitly.
Okay, I'll trust you implicitly. But because it
yeah,
gets overwhelming, and I
it's-
feel irresponsible when I talk to my financial planner. And should I be doing the research myself, or?
Yeah, it's a really good question. I could spend a lot of time on this too. I think you need to educate yourself enough to have some kind of an idea of what your advisor is doing. And what does that mean? It means that you have like a rudimentary understanding of personal finance and the investment recommendations that they make, because you don't want to have the wool pulled over your eyes. I mean, these people that we've seen who got sold things they shouldn't have, that's a problem. But I will say, we've got clients. Lucy was part of that. She was a speaker with Women of Faith. She spoke to arenas full of like 20,000 people. She held them in her hand when she spoke and told stories way better than I could. But her and the other ladies that she spoke with who were clients had absolutely no aptitude for finance, right? I can't speak to 20,000 people. They look at math on a sheet of paper and their head explodes, which is fine. So if your gift is not there, you do need to find someone you can trust, but ideally you'd educate yourself a little bit on it. It's a tough, I mean, Madoff is the worst example of that. Like, people just said, let me in, they gave him their money. He falsified statements, they never asked questions, and the money just went away. Billions. So
because it is overwhelming, but it is worth chipping
yeah.
away at understanding, at least to a degree.
And I'll tell you, there are websites you can go to, like for us, you can check disciplinary history. At a minimum, you want to do that with your advisor, right? See if they've had any complaints against them. They're all out there, but people don't always look at those.
That's good. So I loved what you were saying about life insurance, and I'll just make a comment. You can add to it if you want to, but I just want to say, as a pastor, I've officiated multiple memorial services where there wasn't any money left for the spouse. Funerals for men who either didn't have any insurance for their family, or very small policies that didn't even cover all of the funeral costs. And so I wish we could actually have a line in the back and just sign everybody up for at least a small policy if you don't have it. And I love when you said that it really is inexpensive enough to get started at least.
Yeah, it's not. I mean, it sounds like a sales pitch. We don't sell insurance, so don't hear it that way. But literally, for whatever, $30, $40 a month, you could probably get some pretty decent coverage. And that goes along with the health thing that you were talking about, right? Stay healthy, so your rates are lower. It matters.
So, how about bankruptcy? A couple things. Do you ever advise it?
Yeah.
And then what about a word of hope for people who have gotten so buried, or maybe they have filed, or they're rebuilding?
Yeah.
What would you say to that?
I don't know if I've ever advised bankruptcy. I've recommended like people walk away from a house, I think once in my life. I don't like to. I feel like if you take out an obligation, you should fulfill it. But in some cases, it's simply not possible. So if it has to happen, I believe that morally it's an option that can be pursued, right? Or I happen to like capitalism. I think it's a good system. I think there has to be some kind of an exit for someone who gets in trouble in this system, and that's bankruptcy. So if it's got to happen, it's got to happen. I mean, you exhaust all means available to you before you have to do it. But if you got to do it, you got to do it.
Do you work with people who have filed and then they're just working through putting the pieces back together?
Yeah, to be honest, I'm not sure we've ever worked with someone who's been through. I mean, it's not a cool thing. It stays with you for a little while, and I don't know if you've ever worked with someone who's been through it. It's a good question. I don't think so.
Okay. Well, let's see. How about buying versus renting? I know we always talk about renting is throwing money away. We also live in a place where a tiny condo is $600,000. Right. Do you ever advise just rent, or do you always say you must purchase?
Yeah, I think I do believe in owning assets long term, so that's the first option. I also recognize right now that like it's not a good thing to play in the sandbox of the real estate market. It's really hard to buy anything. So like at the moment, if you were to ask me, and especially if someone's just starting out and they don't have the money scraped together, I don't have a problem if they rent for a little while. I would say do it with an eye toward owning over the long term. That's the better way to do it. But right now it's just, so my daughter's graduating from college in May. She goes to college up in Oregon. I don't know how she's ever going to afford a house. To have 20% down, which is an ideal kind of a thing, around here you need to have $100,000. And how do you pile that up quickly? So it's a tough situation. I wish I had a better answer. I always do. Yeah.
That's good. I know you just gave us an entire presentation, but how about summarizing the whole thing in 30 seconds for a 25-year-old.
For a 25-year-old, wow. So you saved the easiest question for last. Is that what it is? I'll give the high points, and it's kind of along the lines of these slides. Live within your means is the best thing that you can do. I truly believe that being charitable, even when you don't have a lot to be charitable with, is a good thing. So live within your means, be charitable, and along with that, along with living within your means, is implied, I think, don't try to keep up with the Joneses or anybody else. We see people all the time. It's that mentality of like big hat, no cattle. They look good on the outside. They don't have any cattle on the inside. A lot of times, I think the people that you're trying to keep up with, you don't really want to be them, right? So it's better. Actually, our clients they trend toward the millionaire next door, if you know that. They're people who are pretty successful and in some cases kind of wealthy, but you can't tell it from the outside. That's the best advice I'd give to someone. Don't try and look wealthy on the outside, but keep it under the radar and do the right things under the hood.
That's good. Perfect. Yeah. And then, so my son-in-law is 25. I just turned 50. So for a 50-year-old, your advice would probably be so good. It was. Yeah. So I'm not ready to retire anytime soon, but it's sooner than I think. And so this would be the time to really be knowing how much, what my projection is. And
Yeah, we work with people an awful lot. The thing is, sometimes there's not maybe a lot that can be done. Like I'll pick on you. Take your situation. Maybe you're doing everything right, but to have a target out there, to have a retirement projection that gets run that says, okay, if you wanted to retire at whatever 65, this is what you've got now. This is what it might do over the next 15 years. So this is what we think you ought to be trying to put away on a monthly basis. Let's say just to know that target is there and it's something that you can be reaching for. I'm the same age. There's so much that gets in the way. There's kids. There's club sports that you want to pay for your kids. There's private schools, whatever it is. So at the end of the day, you do what you can, but to know what the target is, I think, is a valuable thing.
Perfect. Okay, one more, and then if you thought of anything else you want to add, we're doing good on time. So yay or nay on long-term assisted living insurance? I don't know if I'm saying that right.
Yeah, long-term care insurance. Yeah, that's a tricky area. I'll tell you, we have clients that have that. The problem with that recently is that these they bought the insurance, let's say 10 years ago, and their premium is, let's say, $1,000 a year. Everyone's getting these notices now. The premiums are going up by, in some cases, like 300%. So what was $100 a month is becoming $400 a month. It's a weird kind of a place right now. I don't like to recommend it, but we feel obligated to recommend it to people who are in what we call the middle. If you're below a certain level of, let's say, income, you really can't afford to pay the premiums, so problem solved, you can't do it, so you don't need to. If you've got more than, I don't know, $3 million, let's say, in assets, you can probably afford to self-insure, which means if you had to go into a facility or get care, you could pay for it yourself. So in that situation, you probably don't need to buy it, but most of us are in the middle, right? Almost everybody's in the middle, so I would say that virtually everyone should consider it, but it's a tough recommendation to make. I think the average stay in a nursing home, if you look at the stats, turns out to be like 4 or 5 months, because unfortunately people pass away once they get in. A lot of times the policies they're called elimination periods of 90 days where they won't pay for the first 90 days that you're in a facility. So you get to a point where like the average payout on a policy is only going to be 2 or 3 months worth of benefits. And so, I mean, from a dollars and cents perspective, that's not worth it. But the guy who hired me out of college, his mom had a stroke like 6 months after I started working at the place I still work. She was in a nursing home for 15 years. So, I mean, you can see it on both sides. So consider it, but tread cautiously. I don't know. It's a rough one. Okay. Yeah, good questions. These are hard.
You're doing great. So, anything that you want to add? Did anything come to your mind that you wish you had said that you want to parting shot?
No, I don't think so. I think I went through enough.
Okay.